Y'all, real talk. If an investor offers you $100,000 today to fund their fix and flip, rental, or subject to deal, would you take it? Or what if they offered you a penny doubling every day for 30 days to fund their deal? Would you take it? It's no secret that the penny doubling every day for 30 days is the wiser choice. But why are so many private money lenders choosing the $100,000? Honestly, y'all, I really don't know. And I bet you thought I had an answer for you. But just give me a minute, give me a few minutes, and we can see what the math says. The question really isn't about the money at all. It's about having a banker's mindset. This mindset should be applied to every investment decision you make. Look, if you know Elridge and I drop absolute dimes on this channel, then hit the subscribe button. And of course, like it too. This is the most important video on this channel, and you really should watch till the end to see why. I'm Anitra Preston, co-founder of Vertical Capital. I'm a lender, not a broker. We lend money to real estate investors and developers in New Orleans and Baton Rouge. Okay, so y'all, the other day I was surfing in Facebook and found a pitch. An investor was looking for some capital to fund their real estate deal. And the pitch sounds just like this. In fact, I'm just going to read it. Anyone have a self-directed retirement account they're looking to grow, or some idle cash they're looking to put to work? I'm looking for an individual to lend $48,000 secured by property in New Orleans that I'm buying subject to a first mortgage. The ARV after repair value is $220,000. The combined LTV is 75%. They're paying 8% interest only, and they're looking for a 5-year maximum term, but a 1-year would do. Sounds pretty good? Maybe, or maybe not. Now, it's common for an investor to seek private money to fund their deals. This is very common. Let's be clear. They are not looking for folks like me, where private money lending is my primary business. They're looking for folks just like you, who are just getting started. You still have a primary career. You're looking to diversify your retirement. You're looking to grow your retirement. Your experience level may be beginner or intermediate, and it's safe to add that you're not an active investor, meaning you're not in real estate, or you're not doing stock trading or what have you, right? So what's the purpose? And so what are you trying to say to me? First, I want to let you know all of these videos that we make are for educational purposes only. It is our goal to make you a better investment if you are a beginner, and if you're learning and if you are intermediate and you want to learn about private money lending. These videos are created so you can see what we see and why we consider loans to be safe or not safe, profitable or not profitable, right? And again, we want to always make sure we're in a position, or our capital's in a position that has the least amount of risk. So I'm going to break down this offer to you. So let's look at it. So let's take a look at it. So the investor is looking for an individual who has a self-directed retirement account, right, with at least $48,000 in it. If you have a 401k, it doesn't mean you don't necessarily qualify. It means you just have to roll that over into a self-directed IRA. You want more on that, go ahead and download our free ebook on how to invest with your retirement accounts. I go over that in the free ebook. This, in the investment type for this loan, is subject to an existing mortgage. I'm going to go into much detail on why this should be scrutinized heavily by you as an individual private money lender, right? The ARV is $220,000. The combined LTV is 75%, right? Meaning The first loan is $117,000 plus your second loan, which is the $48,000, totals $165,000. $165,000 should be 75% of $220,000. Again, we want to confirm the first loan is $117,000. We also want to confirm with this investor if this $117,000 loan is a 30-year fixed and it's not behind any other private or hard money lender. That's an absolute no-no. So second lien position, I'm going to dive right in this. The second lien position is the riskiest position that you can place your capital. I'm going to repeat that loud and clear. The second lien position is the riskiest position that you could put your money in a deal or a loan, right behind earnest money deposit. So earnest money deposit is probably number one risk. And the second lien is the riskiest, the second riskiest, right? And so let's take a look at this a little bit. So on second lien position, generally the practice is you ask for additional collateral to secure your money. So when you get pitched by fix and flipper, or you get pitched by a subject to or someone who wants a rental, it's safe to say that they're not offering additional collateral for you to secure in a second lien position. It's safe to assume that. But us who do this on a primary basis, who do this every day, we do ask for additional collateral, right? To safeguard or to mitigate our risk or mitigate any damages, any event that something happens to the first lien, right? And so the assumption here is that the protective equity spread, right? I believe the equity spread here is 25%. The assumption is that 25%, the remaining 25%, is enough that's going to recover this $117,000 and this $48,000. But remember, we have no idea what this person could charge as far as attorney fees, all kind of stuff could happen, right? So I don't want to go down a rabbit hole, but I just want to just make that very clear. Number two, let's talk about the subject to the existing mortgage, right? You have to be aware that this first lien person could call this balance due if ownership is transferred. So this clause protects the lender for those buyers assuming loans with below market rate interest rates. So the due on sale clause happens, right? Now, the rebuttal that the subject to investor is going to make, he's going to say, this rarely happens. It's the school of thought of it could, but do it, right? But look, let's take a look here. I want to take a look at something that happened just last month. This is an investor that I know here locally in New Orleans, and he posts, I got a letter that all subject to investors feel. The due on sale clause. We all know you're not likely to get this letter, but not likely does not mean it's not possible. And this is what I want you to home in on. Although it's not likely, it doesn't mean that it's not possible. It's very well possible that this subject to investor can get the due on sale clause. So this is literally the worst case scenario for a subject to deal, particularly since this happened almost immediately after I bought the property. So you have to be aware that this thing could happen. So I'm not saying this out of fear, but we definitely cannot ignore this as a second lien position lender, right? And so this is one of obvious reasons why you should always ask for additional collateral. So the 8%, y'all, in second lien position, rule number one, second lien position loans, interest rates are always higher than first lien interest rates. Right now, at this 8%, this investor is actually offering you lower than the going rate of a first lien position. Now think about that for instance. I'm sorry, about the same rate as a first lien position. And if you Google what the average loan is on investment property, it's going to come back 7 to 8%. If you Google what the average percent is for someone buying a primary home, it should come around 6 to 7%. But we're dealing in investment property, so we want to compare apples to apples, right? So right now, the average interest rate is hovering around 8% in a first lien position. You have to think about that. First lien, 8%, right? These borrowers have to qualify to get to the 8%. These agencies or these lenders, these national lenders, these banks that pull in credit reports, you got to do financials. You have to really prove yourself. In this situation, are you vetting the person that offered this? Are you doing credit reports? Are you pulling financials? Are you pulling bank statements? How much underwriting are you doing for this 8% in first, and you're doing it in second position? So this right here is a little, I wouldn't call this as a strong offer, right? So let's go down there. Let's take a look at it. I want to make it clear. I'm in the middle of a refinance. I am refinancing myself out of a vertical capital loan to permanent financing. This person is going to be in first lien position on my property at 161921 Mandeville in New Orleans. I'm a 30-year fixed, right? Fixed rate. It's a conventional loan. Look at that interest rate. 8.625%, right? It says right here, second lien loan rates. I put this here. Second lien loan rates are higher than first lien loan rates. Much, much higher. And in fact, the average is about 3% higher than the first lien. So a first lien is offering 8.62%. In second lien position, right now, you should be at 10, 11. You should be around 11, 12% with this fee. So I just wanted to show you this to let you know that, to let you see what's out there, and the research is there for you to do that, right? So you got to understand that the more experience the investor has, typically he will make an offer that best benefits him, right? And I'm not saying that to a buyer-seller situation, because I do believe that these creative real estate investors do great jobs at structuring deals to where it typically helps the seller get out of certain situation. But it's not always structurally sound for the capital partner coming in, right? And here's the thing. He who owns the goal calls the shots, right? So you're the capital in this. And you got to understand that the bank makes all the rules. I know a lot of times we're eager to get started in something, right? And then we see these offers fly around, and we see other people comment, oh, send me the deal, send me the deal. And so you get this euphoria that, hey, this might be really great because other people are inquiring about it. But because you're with vertical capital, when you're looking at this video, you're not other people, all right? So let's get into it. So let the math speak, right? We're about to talk with the math, right? So the offer as presented, this is what the investor is presenting. She's presenting this deal to everyday Joe. The loan amount, $48,000. Interest rate, 8%. Monthly interest payment is $320. Loan term is 12 months. Lien position is second, which is the riskiest. Your total interest income for the year is $3,840. When you add that back to your $48,000 at the end of the loan term, you'll have your retirement account grew to $51,840. All right. Now remember, this is the 1-year term that they would be willing to accept. The 5-year term is what they're looking for. This is everyday Joe surfing the internet. He got $48,000 cash. He got $48,000 in his retirement account, just sitting around doing nothing. The investor is offering you 8% interest. Again, the monthly payment is $320. The long term is for 60 months. That's 5 years. This is the desired loan. Yeah, second lien position, again, the riskiest position out there. And the total interest income is $19,200 and $200. So when you add that 48 to the 19, oh, my math is right. It's not. It should be $67,200, right? So there should be a 2 here. I'm going to change it right here on screen. So it should be $67,200. So at the end of a 60-month term, in the most riskiest position, and again, we got to assume this ARV means that it's not even at the 220. It's possibly lower because we have to make improvements. We always want to look at as-is value as well. So you got your initial investment at 48, and you walk away again with $67,200. Not bad. If you let it sit for 60 months, or is it? Let's take a look and see how would this look if you kept your $48,000 moving year after year after year after year for 5 years, instead of it sitting in one deal for 5 years, right? So again, we loaned our principal and interest back out year over year for 5 years. Let's see what that looks like. So in a compounding environment with vertical capital, we pay 10%, not 8%. You're not in second lien position with us. You're in first lien position, meaning we're first. We're first, right? So we got compounded Corey here in year 1. His loan investment was $48,000. I'm using the same one. I'm using 10% because that's what we paid. His monthly payments is $400, 12-month term. Lien position first, right? Mitigated our risk. You got $4,800. You add that to his $48,000. At the end of the 12 months, you got $52,800. So in a compounding environment, we assume our principal and interest will be reinvested in year 2. So now compounding Corey in year 2 starts off with $52,800. We loan this back out. We pay 10%. Your monthly payment is $440, 12 months. First lien position, not a risky position. $5,200, $58,080. And if we do that, remember, we're carrying our principal interest into the new year, into a new loan at an interest rate of 10%. He'll end with $63,888. You can clearly see by year 4, Corey has already grew his retirement account in this instance in year 4. It's $70,276.80. You're getting $67,200 in 5 years with this investor in the riskiest position possible. I want to let that sit. In 4 years, you get $70,000 in a position where it's not a lot of risk. You're in first lien position. You're earning way more in first lien position at 10%. We're compounding it. And in year 4, your retirement account has grown from $48,000 to $70,276.80. You've got to let this marinate. Now, then we take this again in year 5. At the end of year 5, you're at $77,303.52 versus the end of year 5 with investor number 1. at $67,200. Now, this is the question that I asked you earlier. Would you take $100,000 today, or would you take the penny doubling every 30 days on investor number 2? This is an example of the difference in the mindset, right? In this example right here, we're not using any finance at all. We're using simple. We're not analyzing anything. We're not using any principles. Elridge and I talk about 4 principles on there: where your money resides, the velocity of money, strategic debt, compounding interest, and those are the 4 key components. And here we're using about 3 to 4 of them. We're using compounding interest, we're using the velocity of money, and we're using 3 of the 4, and we're using where the money resides, right? That bulk, where your money actually sits. So if you did this yourself, the rates could be as high as 12 to 18% in some markets. And I'm not including fees and points, and that just adds added bonus to it, right? So I went and took a step a little bit further. I wanted to do some additional research, and I wanted to show you. Look, if you want to learn how to do this and you want to learn how to do it yourself, download our free ebook or join our community. We teach this stuff in our community, right? And again, I told you, in second lien position, you probably could be somewhere around 13, 12, 18% if you're going to do second lien position. But right now, it's first lien position. Even if you're doing this yourself in first lien position, you automatically can get charged 12 to 18% just on first lien position, which is the safest position to lend your money in, right? Or what we call the position that has the less risk. So if your money is sitting in your self-directed retirement account, like the investor is pitching, that means you're not earning any interest, because a self-directed, you're the one that's controlling those investments. It's assuming that it's sitting in there. There's no interest. It's not tied to Wall Street or stocks and bonds. It's tied to whatever you put, right? So it's at 0%. Now, if you have it sitting in a 401k, the average 401k for 2023 earned an annual 9.7%. This investor is offering you 8%. Based on this offer, if you move this $48,000 from this retirement account and move it over here to loan to this person, you're losing. And if you did this yourself, you would be at 12 to 18%. So let's look at the offer again. The offer that is being offered is super risky, in my opinion. Why? We're in second lien position. There's all kinds of things that can possibly go wrong. We have below market rate. The offer, the interest payment is below market rate. So in this instance, is the juice worth the squeeze? My opinion, probably not. 75% LTV is a little high for second lien position. You probably want a little more than 25% of protected equity here. Remember, because that 25% is not all your 25%. That's also assuming that the first lien may not eat up all that 25%, right, on their diligence to recover if something goes wrong. Meaning that they press for the loan to be due, and they may push towards foreclosure. What happens then? Interest starts calculating and fees start calculating. So some of that stuff can be eaten up in the 25%. 48,000 is a low number, but you still got to consider this is your retirement cost. This is money you've saved to retire. So it makes the risk a little bit more higher, in my opinion, because now we're using funds that we worth so dearly to save for when we want to retire, right? So you got to be careful. So the question is, do you have the banker's mindset? And hopefully after the end of this video, your answer should be yes. All of this information is free out here. If you have any questions, just drop a comment. I'll be more than happy to answer. Or you can join our community. There's a team of people waiting to assist you.